Let's get back to the plunge in bond yields and continue this discussion. Joining us now, Allianz Chief Economic Advisor Mohamed El-Erian. If you hear a lot of the previous discussion, Mohamed, agree with much of that, or have some, can you drill down on some of those points, maybe?
Yes, absolutely. Good morning, Joe. I mean, I would add 2 points. One is that the CPI number highlights the dilemma facing the Fed, which is neither the real economy nor inflation is calling for what the market has priced in, but the Fed will have no choice but to deliver what the market has priced in. That's the first set of dilemma. And the second one is look at how the narrative has evolved. It used to be the Fed can help us avoid a slowdown. Then it went to the Fed is pushing on a string, but it's okay. It helps financial markets. This morning on your show, you had guests saying that rate cuts would be bad for markets. And what we're seeing is that the Fed is being viewed increasingly as being less effective, and people are starting to worry about the risks and the unintended consequences. So I think these 2 things are really important, Joe.
How do you think, can you give us an idea when we're getting near the terminal price for some of this stuff, Mohamed? Are we close on the 30-year? Are we close on the 10-year, do you think?
I think no one knows because of 15 trillion of negative yielding bonds around the world. So this is not a U.S. story. This is well beyond a U.S. story. But remember, we relied on central banks to stop the spillback from messy politics into the markets and the economy. Now that they're becoming less effective, markets are becoming much more sensitive to political dislocations, and there's a whole host of political dislocation, and the list is getting longer, not shorter.
You know, Mohamed, you've had some good handicapping of the China negotiations that we've seen. I wondered if you've changed your probabilities for how outcomes are in the last couple of weeks with what we've seen.
I haven't. I think the best that you could hope for if you're looking for some resolution of tension is a temporary ceasefire. But that ceasefire will prove not just temporary, but reversible. We are looking at further escalation of trade tensions. And I can go into the reasons, but whether you look at the China side or the U.S. side, both are suggesting that we'll get further escalation.
And what does that mean for the U.S. economy? You've been pretty bullish overall on our ability to weather this trade war and for the economy to keep moving forward. What's your recession probability now for the next 12 months? Is it 1 out of 3?
No, it's lower than that. I think the economy is fine, and your business confidence number today show that. You're looking at growth in the range of 2 to 2.5%. The problem is not the economy. The problem is that the markets are much more sensitive to what happens outside because the markets are more open to the global economy. And the thing that you've got to fear is a self-fulfilling concern, that it starts on the business side, on business investment, and then spreads to consumption. But on a standalone basis, the economy is in a good place. Markets have been decoupled, and now we're seeing what happens when suddenly politics contaminate markets.
We've talked all morning about, on our side, we have an election that President Xi knows about, and we understand that Hong Kong is probably problematic for President Xi. What is a bigger force in your view, and how does Hong Kong eventually play out politically, do you think?
So I don't know how Hong Kong plays out. The strategy of waiting it out isn't working. The protests are getting more effective. So China faces a dilemma between intervention with all the consequences of that, or letting the protests get worse and worry about the demonstration effect to mainland China and to Taiwan. But from the U.S. perspective, that's what's important, Joe. The incentive to deal with China right now is less. If you're worried about national security, and this is about national security as well as economics, you wait. China is getting weaker and weaker, and you just wait this out. Yes, there's going to be damage to the U.S. economy, but if you're playing the long game, it's the right thing to do.
Yeah, it almost, all's fair in love and war, but it seems like both sides, they say, oh, no, they're going to compartmentalize it, and they wouldn't, we wouldn't let that influence what we do. But, I mean, I wonder, Mohamed, we don't want to say Arab Spring with China, but someday, right? I mean, someday there's going to be something similar to that in mainland China. I don't just know how long you can keep forestalling that eventuality. Do you know?
I don't. And remember that the development economists who look closely at China always raise two anomalies. One is you got economic liberalization, but not political liberalization. And the question was, how long can that last? Second, China was the biggest economy trying what's called the middle income transition. It's very technical. It's basically an adolescent becoming an adult. You've got to do things differently.
But if that stalls, you can't keep everyone, that's necessary to keep moving forward, to keep everyone, to sort of keep everyone placated. And that's why I think it is related to the trade talks with the U.S.
No, I agree. I totally agree. And that's why you have this narrative in D.C. If not now, when? Yeah. When would we do this if not now?